4 days from now, on May 1st, a new rule will be implemented.
As the Biden administration is planning to force homebuyers with good credit to pay more for their mortgages so that they can subsidize the loans of high-risk borrowers.
It's a bad policy step. It lacks integrity. And that's not how we should be making housing policy right now.
It's a direct attempt to inject socialism into the economy.
This news created a lot of noise and a lot of confusion. So in this video, I'm going to clarify what does this all mean for new home buyers and how does this affect the commercial real estate space. Traditionally, when you apply for a loan and you have good credit scores, you get the best interest rates at the time of your application. What partly affects the interest rate is what is called an LLPA, or a loan level price adjustment. The LLPA is adjusted based on loan features such as credit score, down payment, and loan purpose. LLPAs are only applied to conventional loans or loans that fit Fannie or Freddie lending standards. So your non-conforming loans such as FHA, VA, or USDA are not affected by the LLPAs. So why is this happening right now? Actually, this initiative hit the public eye back in January of 2023. We're just hearing about it again because the implementation date is coming up soon. But it seems like there are two popular reasons why this is getting a lot of attention. The first one is a political one because the elections are coming up, and this could possibly be a move to sway voters. The second reason is because it's long been Fannie Mae and Freddie Mac's mission to provide affordable housing for the public. Because of the higher interest rates, these two GSEs are trying to close the gap for home buyers and get them to their first home. Alright, before you start paying late and intentionally trying to lower your credit score, let me clarify a couple of things. For one, this only applies to new loans, so your current mortgage payments will still stay the same. And secondly, you will not be paying less if you have a lower credit score. So check out this chart. Credit to Mortgage News Daily. Everything in red is an increase, while green is a decrease in the LLPA. So for those who usually put a 20% down payment and have a credit score of 720 or higher, they're going to get hit with a 0.75% increase, while those with a 620 credit score gets the biggest discount of 2% off of the previous LLPA. This chart shows the actual percentage. Using this chart, you'll see why you'll still be paying more with a lower credit score. If you have a credit score of 740 and put a 20% down payment, you'll be paying close to 0.9%. But if you have a credit score of 640 and make the same down payment, you'll be paying 2.25%. On a $300,000 loan, those with a 640 credit score will pay $4,125 more than those with a 740 credit score. Hopefully this clarifies the clickbait headlines, but it doesn't change the fact that those with good credit scores are being punished for it. You see, LLPAs are meant to hedge the risk for high-risk borrowers. So basic economy applies. If you give discounts, you'll have to increase prices somewhere to balance out the changes. On a $400,000 loan, those with good credit scores will be paying $40 more per month because that's the 1% change from 0.25%. Let me know what are your thoughts about this new mortgage rule in the comments below. So what does this all mean for commercial real estate? I would say there wouldn't be any major changes. This new rule doesn't change the fact that the interest rate for a 30-year mortgage is close to 7%, nor does it change the seller's minds of lowering their prices. And as I mentioned earlier, this new mortgage law does not affect FHA, and a lot of people can apply for it still. Whilst people are not able to save for a down payment and or qualify for a loan, renting will still be a primary option for getting a place to live. In the grand scheme of things, is this a bad thing for real estate? Should you avoid real estate altogether? I would say no. There are far worse times in history to buy real estate, and people still bought.
My wife and I, we were paying, when we moved to Cleveland, Mark, back in the 70s, we were paying 18%.
Wow.
No one gave us anything.
Right.
We just struggled and worked our way through it.
If you know what you're doing, you'll know how to make money in any market cycle. And with experience, you'll know how to take advantage of new policies. If you're a long-term investor and want to know stories of how lucrative real estate can be even with 20% down payment, then watch this video next. Perry shares his experience on how he's able to do it with 7 residential properties.